Hello and welcome to this special show. The last couple of weeks have been very painful for investors. It has shown many that making money in the stock market is very, very hard. It's a very basic, simple truth which got ignored for a long time. Momentum investing took over. People thought, well, the other guy is making money, so I should as well. The bubble got pricked. I'm using the word bubble carefully here. Got pricked, and many say it's a good thing. With me today is Raamdeo Agrawal, needs no introduction. He's Joint Managing Director at Motilal Oswal Securities. Thank you very much, sir, for joining us here. And I'm not going to ask him what is really going to happen to the market, but we're going to discuss some first principles of investing. He's often referred to as the Warren Buffett of India. I don't think it's high praise for you.
Disciple of Buffett. Yeah,
Disciple of Buffett. Okay, fair enough. In my hand is a memo which I think comes in very, very handy at this point in time. It's a note from a guy called Howard Marks. You should search him up on the internet. He's one of the gurus of investing. He's an investor himself, runs a firm called Oak Tree, and he writes pretty regularly and extensively on investing as well. The title of this note, Raamdeo, is very simply put, it's not easy, right? It's elementary.
Yeah, very elementary.
Right? So what is so special about this?
Yeah, so I mean, to my own experience, I used to say people that because I'm in the market for last 35 years. 1980 I bought the first stocks, and I don't have a background of buying stocks. I mean, family business, not farming, so we never bought stocks. So it has taken a while for me to really get a grips of that we are doing something sensible. And I used to keep telling people that open heart surgery you can learn in school. Somebody can teach you in college, but not investing. Investing you have to learn by committing mistakes, reading, visiting the companies, again buying something, again committing mistakes. So you do left, right, and then you reach to some kind of a investment philosophy which works for you better than what it was not working in the past. So it's very time consuming, and you need to be passionate enough to last for 15, 20, 25 years. Like 35 years for me, I'm as passionate about the stocks as I was in 1980.
Has it become easy for you, by the way, now?
It's not easy, but I know some of the mistakes which happen. So, emotionally I'm in much better shape now. I mean, when I started, I used to go like a ping pong with the market. Now I know, okay, I have committed mistake, I need to be punished. And then rewards come. I know that reversion will happen. If you are outperformed by 40% or 35%, I know it cannot continue like this. It will come down, and how, we don't know, but it will come down. So it goes on. But I'm in much better frame of mind to understand the market and what I'm doing and why I'm getting rewarded or why I'm getting punished. So otherwise it was a black box in the beginning.
I want to read out something from this particular note here. And I'm quoting here from Howard Marks' latest note. People buy bargains and apply the approaches. The result is that the efforts of these market participants tend to drive out opportunities for easy money. Sacrifices become more, securities become more fairly priced, and free lunches become harder to find. It makes no sense to think it would be otherwise. It's a very simple principle that the market is, in a way, efficient. You have to find inefficiency, but it's very wrong to assume, stupid to assume that, well.
So he says in the note going forward that one of the jobs, apart from mobilizing capital, providing liquidity, one of the jobs of the market is to drive out excess returns from the system as early as possible. So the moment any regulatory changes come or anything changes in metrics and the profits, the profit potential of the company changes, it's a market's job very quickly to price it up and kind of so excess profit doesn't remain on the table. Same way, if profits have crashed for some reason, it is the job of the market immediately to reprice the stock for the reduced optimism about the future of the company. So you have to have that confidence that if you are looking at something which is grossly underpriced for whatever reason, because you are ahead of the time, you understand the business, you can see next 10-15 years, you can see the power of innovation or power of regulatory change or power of growth of the market or power of increasing the margin, declining the cost. So if you only understand the market doesn't know, in that case you should be confident that market will reward you for your forecast coming right. So whatever you forecast, if it is correct and it was not known to the market, you will be handsomely rewarded.
But it is also important to know what is the wide perception, right?
Yeah, that's why you have to be stuck to the market. And I say that every day you have to keep reading, you have to keep feeling what market has discounted, because whatever has come in the news and generally the analyst reports and all, they're already part of the current price. So what is that you know more than what the market knows?
What is your edge, essentially?
Yes.
That's the point. There is also a little bit about different levels of thinking. First level of thinking, second level of thinking. It kind of ties up with what you were saying.
Yes.
Right?
So, what happens is that, simply somebody says that what are products you like. If you buy the stocks underlying, you'll do well. But there can be a big issue out there, because the products you like, probably they might have underlying, the business might be very bad.
Okay.
You're using a telecom, but the company might be, say you are using BSNL. Because the only network which works in particular region is, say, BSNL. You are using BSNL. BSNL is bad shape, terrible shape.
Sure.
So if you go and buy BSNL shares, you'll have a problem. That kind of thing. So you have, so second level of thinking is, what is the quality of business you have?
Okay.
And how the pricing has happened. So don't make things very simple, because markets have, whatever is good or whatever is bad, market has already discounted that. So what is the advantage you have when you are looking at it? So when you walk in like a simple guy,
sure,
this is looking good, but market has already paid the price for looking good. Hindustan Lever is a great company.
Yeah. Yeah.
But great company doesn't make a great investment. If your return requirement is 25%, Hindustan Lever will find it very difficult to give you that kind of return.
Yeah.
So there is a quality, but the growth from where the return is going to come, that to best of my knowledge is not going to be anywhere close to 20-25%, and hence your return is going to be far lower.
There's a paragraph here which kind of summarizes what you're saying. The bottom line is that first level thinkers see what's on the surface, react to it simplistically, and buy and sell on the basis of the reactions.
I can confess, till about say 2003, 4, 5, I think for first 20 years I was like first level thinker, and that's why it was not making money.
But tell me something, with so much, when you started out, access to information,
it was very low.
I mean, you were not reading what Howard Marks was writing,
No,
right?
Not at all.
People who are starting now have all this. I mean, if they want to, it's available, it's out there for them. Do you think you can, be faster in terms of transitioning to a more sophisticated thinker?
Faster is doubtful, but you can become much better guy, much faster. In the sense that it will take same 25 years, but in 25 years what will come out will be far superior, far global.
Okay.
So I would think that investing is also a lot commonsensical. That you cannot take away even in 80s. Probably the common sense were much more in 1980 than today. So clearly we benefited out of using our own intuitive skills and those kind of things, rather than going for the bookish knowledge. But come 90s and all, and you got all the books and internet and everything. So that has also cluttered the thought process. So in a cluttered environment, to think very clearly in a very simplistic way, is very tough.
Another, I think, video that I was watching from NYU Professor Ashwath Damodaran, he was talking about, when you read research reports, for example, just to give an example, is the analyst pricing the stock, or is he valuing the stock? I mean, we regularly read these reports, but we don't know is he assigning a price to the stock, or is he really valuing the business?
No, he is only valuing the business. Price the market will put. Whatever might be his, but he can only evaluate.
Right.
As an academician, I can say that this stock should be worth 100 rupees or 200 rupees.
Sure.
But what will be the price? Definitely price will not match with the evaluation. There will be a huge gap.
The note, this note also talks about a lot of things which seem counterintuitive, right? So for example, so he says that Howard Marks says, if everyone likes it, it's probably because it has been doing well, right? I mean, we regularly say, oh, that's a great story, everyone knows about it. Does that mean that one should go ahead and buy that stock? Or one says, oh, that's a terrible idea. Everyone knows it's a terrible idea. And he says that these are opportunities which have allowed him to make the maximum returns in his career, both on the upside and the downside. Can you explain that?
Yeah, so what happens is, in my experience, like Asian Paints. So I used to think that of course, it was a great company. Everybody was saying great. And say in 90s, I wanted to pay a P multiple of say 15. It was about 20. When in 2000, when I wanted to pay 20, the P multiple was 25. So it was always. So I think people misjudge the longevity of the goodness. Longevity. See, markets think that okay, 3, 4, 5 years it will be good, and then it will come to the 4-5% kind of growth. First, in India, size opportunity is untapped opportunity is so massive. I think for next 20, 30 years, the same thing will keep growing at a probably more accelerated fashion. So what is happening is that the pace of growth of Asian Paints in 90s and today it is much higher than last 10 years have been much higher than earlier.
Okay.
Second, the margin has been much better. The market share has been much better. So this was not part of the valuation in 90s. So, in later years, it turned out to be much better than what people thought in 1990. And that's where the understanding of the goodness and longevity of goodness
starts to come in.
Yeah. So if you somehow, for some reason, you think that your knowledge is better than that of market's knowledge about the longevity and goodness of the company, of course you win. Year after year.
I'll take an example, a name that you like very much, Aisha, for example, is routinely now cited as it's very expensive, but it's a great business.
Yeah.
It's a great business.
What I hear a lot more flat for being expensive than for the compliments for goodness.
This morning I heard someone saying, Aisha, Page, these are great businesses, but there has to be, the price is just too high.
So you
valuations are too high.
What happens is you have to figure out upside and downside. When downside is limited and upside is a lot more, of course you buy. When the upside is limited and downside is a lot, you run away. The real problem comes when the upside is too much and downside is also too much. Then it requires a lot of research. So iShare, Page and all, they have risen by 10 times in the last 4-5 years. Now whether that again 10 times the height is there or only one time is there on the upper end, but downside could be more than 40-50%. That's where you have to be putting research and understanding things, whether it will work for you or it is odds are loaded against you. It's a matter of research.
Can you give us the answer to Aisha and Page?
We have taken our views, we have taken our trims, because as I was explaining you, from 6 to 60 is 10 times, but it's only 54,000 crores. But 60 to 120 is again 60,000 crores, almost 7 more effort, but it will give you only 100%. But here I got 1,000%.
Sure.
So if the company adds up 60,000 crores value further, my payoff is only 100%.
Tell me something, actually, just to go back to what we have seen in the market recently. Market corrected viciously. A lot of the high P stocks, which were high P for a reason, most of them at least, were quality stocks and earnings visibility and things like that. They all did correct, but then in that week, that brutal week, when the that Monday when the Nifty sold off 6%, that week, by Friday they were all back. They all came back. Maybe didn't recover fully.
They didn't recover fully, but you are right. But that day, everything fell by 6%. Low quality, bad quality, growing, not growing, everything was 6-7% down. There were some stocks which were down 20% also, but I don't think that day anything was spared.
I'm not talking about that day, but since the last 2.5 odd weeks, 3 weeks actually, they haven't corrected that much, right?
No, as some after the fall, I think we have seen some recovery. But across my portfolios, I have we fell less. If from 9,000 till 75-7600, if the index fell by 16-17%, we fell by say 9-10% or 12%. So there was a 5-6% lower fall itself.
Sure.
Now on the recovery also, recovery has been very slow. Index has also recovered just about 200-300 points, and we have also recovered somewhat. Maybe 2%, 3% we recovered, but still 9-10% from the top, the gap is there. Maybe the market gap is, index gap is about 12-13%. So clearly it's going to be, this time it has been very slow. There's no V-shaped recovery even for the quality companies.
But still 9-10% from the highs, I think that is a absolutely acceptable outcome. You should be ready for that kind of an outcome at any given point in time, right?
Yeah, that's
and also the fact what they've done, as you said, 10 times from over the last couple of years.
They have grown quite a bit, but 10% portfolio short in 15 days is quite bad. That kind of volatility. See, what happened was for last 1.5 years, market was very smooth. there was not that much, 1 or 2% plus minus, but the volatility was not that high. And then suddenly volatility is spiked, and suddenly we saw 10, 12%, 13% loss. So that is a kind of small shock which people will recover as we go forward.
Right.
Yeah, so there is a bit of step back. The flows which were going big time.
Tell me something. This commonly cited language, this notion, or people say these are the stocks in which everybody has been. I mean, and these are over-owned, much abused word. Many are actually. Does it necessarily make them bad ideas for new investors? Or, for example, they say these are FII over-owned stocks. I mean, so what?
So these popular concepts keep coming. If you have an edge in understanding the company, future of the company, and you think that what you are holding and at current price, it can still double in next 3 years, you should just sit tight. That's how it works, because there will be so much of noise around you. See, when you start, nobody knows about it. So that time it's peaceful. Once it starts becoming successful, then the noise level starts increasing. People will throw you out from the system. It is that noisy. So if you want to hold for 5, 10, 15 years to gain actual potential of the stock, you have to ignore this noise and sit tight.
What else did you sort of learn from this note which we were discussing earlier?
One other thing I was mentioning at the end on page 13, if you concentrate your portfolio, because that's my strategy, if you concentrate your portfolio, your mistakes will kill you.
Right.
If you diversify, the payoff from your success will be diminished. See, if you do huge diversification of 70, 80, 90 stocks, in that case your downside is limited, but in the same process your upside is also limited. So you will go, 2-3, if you are superior than index, you will go 2-3% higher than index, and if you are inferior than the index, you will go 2-3% below the index. So you will just keep going with the index, In our case, with a concentrated portfolio, if you do well, you go boom, 15% ahead, 30% ahead, 25% ahead, And if you do badly, by chance 3-4 stocks go wrong, then you will also do 10% below.
Sure.
The whole the thought process is the skill of investing, which you bring on the table, will differentiate, and that should allow you. Say in 10 years, yes, there will be 2-3 years when you will significantly underperform the index, but 7 years or 8 years, if you significantly outperform the index, the total performance will be huge.
But are you comfortable? You are obviously comfortable and set on this approach, right?
Yeah.
Concentrate.
That's the only way I know.
Right.
Even if I think that it is a wrong way, I will do this only.
You don't think that's the wrong way.
Pardon?
You don't think that's the wrong way.
I started 225 stocks. In 95, 96, I had 225 stocks in a small portfolio.
225?
225. And it took 1 year to clean it up, to bring it down to 15. I am convinced the only way to make serious money and bring conviction on the table is the focused portfolio strategy.
Is the focused portfolio.
Yeah, if you allocate 0.5%, 1% in a portfolio, out of your money, what kind of conviction you are bringing on the table? Whether you know the company's name at all, So I think you win big when you understand the stocks well and allocate with confidence.
HPCL, for example, we were just discussing, is a large portion of your allocations now, right?
I think all the oil marketing companies will do well.
Oil marketing will do well. And some of the others that we mentioned earlier, Page, Aisha, they remain some of the top holdings for you, right?
No, there are changes in the sense that...
you did say that you have trimmed a little bit, which means...
Yeah, so what happens is that when you have taken too much of profit, the stocks are up by 500%, 1000%, first thing is you cannot allocate, more than 15-17%. So in mutual funds you can't go beyond 10%.
Right.
So obviously you have to trim it, or you stop buying.
Right.
So the money comes in, you don't buy, so obviously you're trimming it.
Right. Okay, fair enough. So for our viewers, what is this market volatility combined with the investment wisdom they're hearing from you really mean? What does it translate?
Yeah, so the summary is that in the short run, stocks move with the market. If the market moves by 6%, you might go down by 4%, 3%, but it will move with the market. Fundamentals will have no role to play in the shorter run. And shorter the trend you take, even more irrational it will be. So the stock market movements are most irrational in the short end. But as you go 6 months, 1 year, 2 year, 3 year, 4 year, it becomes perfectly rational. And in the long run, as Benjamin Graham says, it's a weighing machine. So the earnings and fundamentals, they take over the valuation in the market. But that takes at least a quarter, if nothing else. You know, in a quarter also, unless it is a manipulated stock, broadly fundamentals take over. But as you go 6 months, 1 year, 2 years, it's only fundamentals. I mean, if a company is making losses, if it is something is at 8 rupees or 9 rupees, I mean, how far can you flog it? You can flog it to say 15 rupees, 20 rupees.
Yeah.
For 10-15 days. Then again it will come down to 8 rupees because that's where it belongs to, or maybe even lower.
What about the rivers? I mean, something which seemingly has great, which is cheap. Size of the business is large. The business it operates is quite good. Size of opportunity is large, and the stock remains at cheap levels, 3-4p type of names.
Yeah, so that's where the opportunity is.
That's where the
opportunity. If you see, you must.
And do you think for a period of time if the stock doesn't move, is it the market mispricing the stock?
See, every time it doesn't happen that you buy and a stock is given notice that you have bought it and market starts moving.
Sure.
You know, so you have to wait for typically around the results, the next round of results, you get the maximum change in the values. That's what my experience is. It can happen earlier also, but typically it is in the actual announcement of the next result. That's when the appraisal starts happening.
Okay.
If not in one quarter, then next quarter, then next quarter. Then eventually, after 2-3 quarters, if in a series of 20 quarters, in first quarter people will not listen, second quarter they will not listen, but third, fourth, fifth quarter they have to listen. Because it's a change of the value. That's the job of the market. That's what I'm saying. That market's job is to eliminate the excess return. And the excess return elimination will happen only by raising the prices.
Let me come to the market here and now. So how do you see this? Do you see this as a bull market correction? I mean, if you go back to the last bull market, 2004 to 9, there were many 10%, 15%, even 30% corrections. This is now down, 20%, right? From the peak of 9200 or so. So, people have short memories, but what do you think? You think this is just a...
I think the euphoria around Mr. Modi's post-Modi election, which was there, I mean, he was sworn in at about 7200. So, bulk of that euphoria in the market at least is over because earnings didn't follow. There was an expectation that earnings will suddenly start looking very good. So, not only it has not happened in last 12 months, there's no visibility of when the earnings will start climbing. So then people saying that let's get back to from where we started. So that's how the year on year the market is index wise market is flat actually. But there are huge winners and losers within this set. What has happened is because of Chinese collapse, Chinese commodity collapse and a lot of other changes, global changes. There are
just one point, just before we get to China. So you are saying it's primarily, because I put this question as to what is the dominating driver for the correction, and usually the answers are all global. I mean, it's China, it's other things.
Whatever the if earnings would have grown at 25%, I'm quite clear the index would have been higher.
Okay.
We have failed to, or significantly lower interest rate, say like 8% coming down to 5%. There is still a chance that market would have been discounting a little better, but with the same almost interest rate change is very limited, and earnings are not done that well, and there are a lot of global concerns right now. So that's a kind of overlay, but basically earnings are not performed.
But is it become tougher now? The outlook has become tougher? I know it's a macro question, you like to stick to stocks, but it has become a little more muddied, right? China, global growth stalling. I mean, and you got, you were saying that Mr. Modi's government.
In fact, it is far more bullish. Let me tell you. See, when you buy, 5 years out, whatever has to happen, it will happen, isn't it? 2020. So if the stocks were set to double in next 5 years, it will double. Now the issue is that are you buying at 100 rupees today, or you are buying at 95? We are definitely buying at 90. So buying at 90 and going to 200 is a much better thing than buying it 100 and going to 200.
So you're saying it'll be 200 in 5 years?
Yeah, that price is set, whatever it is. So I'm compared to 3 months
I'm
back.
asking you about about your confidence in that forecast. Has that become more difficult to project that?
See, I know one thing: businesses will make a lot more money than what they're making today.
That's
much I'm confident about.
Now you're straight away picking up lines from your. You said you're a disciple of Mr. Buffett.
Yes.
I mean, that is his answer.
Not decide, but that's what I've learned, and that's what helps. See, the companies after companies, they'll make more profits. You have to pick up the companies which are going to make more profit. Simple. Your portfolio will make more profit, and hence you will make more profit. I mean, but the issue is when you are going to pick up the companies and select which is going to make more profit. That selection has to be right. You should not become emotional and because this is the nation's biggest power company or this is the nation's biggest transmission company, so it should be here. No, the only consideration is the profit consideration.
So, is this fall behind us? You think we've seen the worst?
Of course, the fall is behind, but I'd be surprised if there's
another leg down.
I mean, this was a perfect technical call. I mean, I've never seen in many years any technical guy is saying that market is going to crack and it cracking. Typically, whenever they said so, it never cracked. Okay. So this time these guys, they were right.
The technical guys were right.
Right from March, they were after life of index, that it would crack to 70 to 100. It did crack now.
Right.
So I think they've done bulk of the job. In fact, it has done better than what they thought. They thought that it will 74, 75 will come in way out in January, February and all. So it has happened much earlier. So my sense is that and valuations are comfortable now. Market cap of GDP is very comfortable. The businesses are doing well. Outlook for the interest rate cut is very much there right now.
Would you agree that is one of the few points where there is some degree of confidence that cost of capital should be lower 2 years out? I mean, some are saying, well, 1 year.
No, it will be lower, but how much it will help in the earnings growth, that is a very different thing. You know, I mean, how fast it will transmit. See, first thing is that discount rate comes down, then the government has to, banks have to transmit it to the system, and how much actually percolates to the real user. So those things do take time, but clearly it will be helpful in corporate profits, helpful in bringing confidence in the investing, and what it will do is it will make the fixed income little less attractive than what it is today. So even more money will, see, real estate is flat, gold is flat. Now fixed income where you're getting 7-8% on an inflation about 4-5%. I think that is looking on the real interest rate basis, it is looking attractive. Even that will come down. So I think all the roads lead to equity, but equity should be good enough. See, just because you dump money here and somebody else like foreigners are selling, I don't think it works. We need the domestic money flowing and we need the foreigners to stay on here and bring more money, and then the real magic will happen.
Magic of money. Thank you very much, Mr. Agrawal.
Thanks.
Appreciate your time. You've heard it from Mr. Raamdeo Agrawal. We also strongly suggest that you go to the website, and we are providing the link at the bottom of your screen. This note, it's not easy, Howard Marks. Do read it. Very useful to think about investing. Thank you once again, sir.
Thanks.
Thanks indeed.